Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 18th, 2025. Hey, how you doing? Hope you're having a good weekend. Hope you had a good trading week. Good one for the Bulls finally. I am recording this from Santa Marta, Colombia. It seems like I've been down here over 2 months and don't ever want to leave, but just wanted to share a picture with you. That's me with the Kansas City hat. This is my beautiful Colombian girlfriend, Christina. This is Salguero Beach. Just love this beach. Play baseball every day here. And this is our dog, Sky. Nice little picture there, isn't it? Just wanted to share that with you. And boy, if you've ever thought about coming to Colombia, Santa Marta specifically, it's a beautiful place. Just beautiful place. I couldn't recommend it any more highly. Okay, so thanks for coming to the podcast. I hope this is going to be helpful for you. I'm going to do my best. The format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week and all of my opened or closed positions. Actually, I didn't close any this week, all open. And so we're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, what the thinking was that went into taking the position, how I set my emergency stop, how I set my end of bar stop, the partial profits that I'll take or that I took, the significant overhead resistance level of where other rules kick into place or where I am just going to exit the position. And most importantly, really, most importantly, how I position size. Really, I think it's the most important factor in trading is the amount of shares or options that you buy when you enter a trade. And I'll show you the formula that I use that takes into account my total account value and what the volatility of the market is. It's very important to position size based upon the current market volatility. So we'll talk about when I entered the trade, why I entered the trades, and how I am going to manage the trades going forward. After that, we're going to do a few minutes on trader psychology. Always the most important skill in trading is the ability to create a plan and then follow it. You know, if you're honest with yourself, if you follow a good trading plan, you're going to do pretty good. But if your emotions get a hold of you and you exit early, whether it's a gain or whether it's a loss, if you don't follow the plan, that's when things can go south. I mention this each week on the podcast. Get yourself a process that takes everything into account, and whatever it takes, follow that process. And I promise you, I've been trading for almost 30 years now. You are going to have a more relaxed life. You're going to make more money. Your trading is going to be a lot more holistic. So, you know, from someone that's traded almost 30 years, take my advice on this. Whatever it takes, follow that process. All right. So after trading psychology, we are going to take a look at some potential trades for next week. Every Friday night, I go through my master watch list, both on the daily time frames and the weekly time frames, and I look for potential trades for the next week. Now, these markets are not going to be where they need to be yet. That's the key. I look at the charts and say, okay, IBM is here. If it gets to there, that's where the sweet spot is for the trade. That's where I'm going to have confluences or combinations of support, maybe MACD divergences, RSI levels, major moving averages, whatever, or all of them together. And so if it gets there, that would be a good area. That would be a good combination of factors lining up in my favor. It doesn't mean it's going to it has to be a positive trade, far from it, but it does move the odds in your favor. And this is a game of odds and probability. So this is what I do every Friday night, dailies, go through all the daily charts, all the weekly charts, and I pick out ones that, you know, have the potential for next week of getting where they need to be. And if they get there, then I'll consider to take the trade. If they don't, then that's fine. I'll just move on to another market that does. And something will always get there. Like, have you ever listened to a podcast of mine where nothing has got there? No, they will get there, but it will improve your odds dramatically if you identify the area before it gets there. And so when it gets there, you can consider taking the trade. So I hope that's going to be helpful for you, kind of give you an idea of how I look at markets, how I look at combinations of signals, risk to rewards, all this kind of stuff. And if you do find something of value today, I really would appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel around, lets YouTube know there's some valuable content. And if you haven't subscribed, I would appreciate if you could subscribe as well. All right, so let's get the legal disclaimer out of the way. It's about 42 seconds. Hang tight, and when that's over, we'll get rolling. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, done with that, got that out of the way, so let's get rolling. This is my first position is Intel, and I've been in Intel for a while. Usually I'm not in a position this long. Usually things go my way a lot quicker, or things go against me a lot quicker and I get out, but I'm happy to say that this finally worked this week. So I entered Intel all the way back here on December 10th, 2024. So the real question is why I entered it. Well, the reason why I entered it goes all the way back here to the 7th of August. So what was happened on the 7th of August? 7th of August was our lowest close bar before we had a market structure change. And we had a market structure change in this area when we took out this swing high. This little thing here, this little move up, taking out the swing high, brought us from a bearish market structure into a bullish market structure. So whenever you go into a bullish market structure, you can define what your order block was. So this is an order block. Order block, a bullish order block, is the lowest bar close right before you have a market structure change. And so the high and the low of this order block is this green box that goes out into space here. So taking you all the way back here to August, as soon as this here about the 19th broke above this high, then I had this order block defined. And so when you change from a bearish market structure to a bullish market structure, and then you come back into the order block, that's the place to buy. And I did buy here about 9/11, actually had a signal and had this nice trade up. But this order block area, the high and the low of the order block is 2025, the low is 1895. If you run this out into space, this is also a valid time to buy. So bought here, ran up here, I think I got out here, didn't mess with any of this, but on the 10th of December, we poked our head into the order block. And also from a deep dip buy perspective on the RSI, we went under the 30, over the 30. Remember, I like confluence as a signal. So the confluence on this particular trade was, one, it was in a bullish order block, and two, I had a very defined signal of an under 30, over 30. That's a deep dip buy strategy. I trade and I teach 7 different strategies, and this is a combination of 2 of them. Order block strategy, deep dip buy strategy. So I bought here at 2022. Let me get my calculator here because, like I mentioned earlier, position sizing really is the most important part. So I bought here 2022. Let me show you how I position size. So for position size, you you need two pieces of information. One, how large is your trading account? And two, what is the value of the 2 ATR, or in other words, 2 times the average true range. So you can see right now, the average true range is 147. This is going to change every day, but just because it's up here, 147, we'll use that number. So I need to know what the value is of the 2 ATR and then what the value is of my account. So let's just say my account is $100,000. Okay, this works for any, doesn't matter if it's $25,000 or $25 million, but let's just use $100,000. I take 1% of whatever my account value is. 1% of 100,000 is $1,000. Okay. Then I divide it by the value of the 2 ATR. Well, right now it's $1.47 divided by 1.47. It would tell me to buy 680 shares. All right. If you had $1 million trading account, 1% is 10,000 divided by that. Well, whatever that number is going to be. 10 times that, right? So 6,800 shares. If you have $50,000, it's 1% is 500 divided by 1.47. It would be 340. Okay? So, but the $1,000 divided by the 2 ATR, 1.47 would tell me to buy 680 shares. And what's important, why we use the 2 ATR is if volatility is very high, it's going to have you buy fewer shares. If volatility is low, it's going to have you buy more shares. And it makes sense. If volatility doubles or triples, you need to reduce your position size to counterbalance all that volatility. Okay? So that's how I position size. 1% of my total capital divided by the 2 ATR tells me how many shares to buy. So say buy 680 shares there. Okay, so I buy 680 shares at 2022. The first thing I need to do is I need to place an emergency stop. And the emergency stop is exactly the value of the 2 ATR. So buy at 2022, I place my emergency stop $1.47. So if at any time we get down to that emergency stop, I'm out. And how much have I lost? I've lost $1,000 because we just did the math, right? 1,000 divided by 147, and I place my emergency stop exactly 147 below. So the good news, the bad news, the good news, I guess I should say, is that this emergency stop is only hit. And they do get hit. Trust me, they do get hit and you'll lose 1% of your account. But that only happens about 5% of the time in my experience. 95% of the time, if you take a loss, it's going to be because your end bar stop. Because remember, I always have two stops, an emergency stop and an end bar stop. And the end bar stop depends on the strategy that I'm using. So on Intel, the end of bar stop is the bottom of the order block at 1890. If I have a close under 1890, I'm going to get out. And we're going to talk a little bit about this in trader psychology. But if I hit my emergency stop, it doesn't matter what time of the day, right when the market opens or right before the market closes or anywhere in between. If it hits there, I am out because no matter what, I only want to lose 1% of my account. However, on the end bar stop, I wait for the end of the day because the end of the day price is the most important price. And in trader psychology, like I said, I'll get into that a little bit more. And you'll see here how many times we tested that end of bar stop, the bottom of the order block, and it just would not close below, thankfully. All right. So recap. 1, we have a bullish order block. 2, we have an entry signal of an under 30, over 30 deep dip buy. I buy at 2022. I position size correctly based upon how I just showed you. On this, then I place my emergency stop just 2 ATRs below. If that ever get hit, I'm out. I place my end of bar stop on this one. It's a close below the low of the order block at 1890. And the next thing I do is I take my entry price and I look at the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $1.11. And so as soon as I enter, I add whatever the 1.5 value is to my entry price above my entry price. And this is my trailing stop level. If I ever get there, and it's a nice feeling to get there, because once you get there, then another set of rules kick in. And so if I get to trailing stop level like we did on Friday, see, now I'm in trailing stop level. And all that means now is going into the future, if I have a close below a previous bar's low, I am going to get out of half of the remaining shares that I have. So here on Friday, we got to trailing stop level. So Monday, if we close under Friday's low, what will I do? I will exit half. And it's just a good way, because if it's going to go back down, it's going to most likely close below a previous bar's low. And so it's a bit of a red flag. If it just keeps going up, great. I won't do anything. Okay, so the position sizing is a defensive move. Setting your end of bar stop is a defensive move. Your emergency stop is a defensive move. Setting your end of bar stop is a defensive move. Placing your trailing stop level 1.5 ATRs above your entry is also considered a defensive move, because if it gets there and now in the future it closes below, I'm going to sell half. So these are all defensive moves, but I like to incorporate offensive techniques into my trading as well, which means if it moves up a certain amount from the previous bar's close, I'm going to take a little profit into that strength. So let me give you an example of real time what I'm talking about. So I am in right now. I take the closing price 21.48. 21.48. Now, obviously, this changes every day, right? Because you have a new closing price every day. So this is, because I'm in this trade, this is what I'm going to do on Monday. I take my closing price, 21.48. Then I look for the value of the 0.45. Right now, the 0.45 is 33 cents. And again, this will move. This is going to change every day, but this is real time. So I take the closing price, 21.48. I look at the value of the 0.45 is 0.33. I add them together, 21.48 plus 0.33. My first profit target on Monday is going to be placed at 21.81. And how much will I get out of there? I will get out of 10% of however many shares I have remaining. Let's say I have 200 shares remaining. Well, I'm going to get out of 20 shares, but I placed 3 profit targets. First profit target I showed you, closing price plus 0.33 is my first profit target, 21.81. Now I'm going to take the first profit target, 21.81, add it again, plus 0.33. My second profit target for Monday is going to be 22.14. I'm going to do it one more time. I'm going to take the second profit target, 22.14 plus 33 cents. That's going to be my third profit target for Monday. I place 3 profit targets every day. You know, a lot of days if it goes down, I'm not going to get them. I'm not going to hit any. But if it does move up at least 0.45 ATRs, in this case on Monday, 33 cents, I am going to take something off. I always take something off when the market gives it to me. But it has to be a certain amount, not 1 penny, right? But 0.45 makes sense to me for a lot of reasons. So, and the benefit is you're selling into strength, you're reducing your position size as it moves up, which psychologically is good because now you have fewer and fewer and fewer shares. And why is that good? Well, the fewer shares you have, the more likely you are to follow your plan. Okay, and so I do that every day. The 3 profit targets, sometimes I hit 1, sometimes I hit 2, sometimes I hit none, sometimes I hit 3, right? So sometimes I hit more. I hit more on Friday. Okay, so I'm not going to do this on all the positions, just this first one, just to kind of give you some real detail. So here we go one more time. Where the signal was, we came into the bullish order block. The confluence of signal, the added on signal was that we had an under 30 over 30. I position sized correctly, got in at 22.22. Emergency stop 2 ATRs, end of bar stop, closed below the low of the order block, 1890. Place my trailing stop level 1.5 ATRs above. So let's go through the trade a little bit. After I bought the next day and didn't do anything. The next day it moved up. I hit one profit target. Next day went down. Next day moved up. I hit one profit target. Then we had this move down. If I would have closed below 1890, I would have been out of the trade. But look, it tested it to the penny. Moved up, took a little off, then we moved kind of sideways and down, then we moved up, then we had this big reversal down, and then on the 10th, 11th, or 10th, 13th, and 14th, we tested the bottom of that order block, but we did not close below. That's what kept me in the trade. And this is just a good example of how the market did not like anything under 1890, and that is why I set my stop there. On this day, on the 13th, I thought, oh, this is closing under, I got to get out. Nope, it saved me, close above. And then we had a little move up, profit target here, and then I hit 4 profit targets on Friday and got to trailing stop level. So this is a good example of a trade where I held in there because my rules told me stay long, stay long, stay long, and then finally, there was some news on Intel, and so the remaining shares that I have on Intel are up 5.6%. But I think the most enlightening aspect of this trade is how valid the low of that order block of 1890 is. We tested it 1, 2, 3, 4 times. There were no more sellers down there, and if you run out of sellers, you're going to go up. So I'm at trailing stop level at the moment, and so going forward in the future, if I have a close below previous bar's low, I will get out of half of the remaining shares. Right? I started with a full amount of shares, but then I had profit targets, so I have fewer shares now than I did when I began. But however many shares I have on that day, if in the future, if it closes below previous bar's low, I'm going to get out of half. But very happy with Intel. I was in that trade for a long time and underwater most of it, and so we finally got into the green on this one. And like I said, the remaining shares up 5.63%. So good for Intel. ARK. All right. ARK, ARKK. All right. So with Intel, I had a green box below. That was a bullish area. This is the opposite. This is a bearish area. That's why it is red. So why is it red? Well, this is an order block here on the 16th of February. Of December. This is the opposite. This is the highest up bar close before we changed market structure to the downside. This big down bar on the 18th took out this swing low, changed the structure from bullish to bearish. So with bullish, if you break market structure from bearish to bullish, you want to buy the dips in the green. If you go from an uptrend to a downtrend, then I want to sell rallies. I want to short rallies in the red. Make sense? So here we broke structure to the downside. Does that mean I get short there? No, it doesn't. I'm waiting for a move back up and some kind of rejection of the red box. Got close here, but didn't get there. I didn't take the trade. This is where I took the trade on the 6th of January. Why? Because during the day, you can see it poked its head into the bearish order block and then closed below. That was my signal to get short. So I got short here at 61.12. Position size correctly, place my emergency stop 2 ATRs above my end of bar stops, a close above the high of the order block at 63.20. I place my trailing stop level 1.5 ATRs below because I'm short, right? Below because I'm short. And it's the same thing. If it moves the value of 0.45, I'm going to start taking profits, partial profits. So I got short here, 61.12. Next day, just collapsed. I hit 3 profit targets on that day. So I locked in 30%. Market can't take it away from me. Next day, we went down Again, I hit another profit target, but more importantly, I got to trailing stop level. And all that trailing stop level means, sorry, I need a drink of water. All that trailing stop means is that if I get to trailing stop level now, because this is a short trade, if I have a close above a previous bar's high, I will get out of half. So got to trailing stop level, next bar, down again. I hit 2 more profit targets. Next bar, down again, 2 more profit targets, right? So I really took advantage of covering that trade into this weakness. Next day we go up higher, but we did not close above that high, so uh, I stayed short. I didn't cover half. But here on the 15th, we did. This was the first close above a previous bar's high because I'm short. So what did I do? I covered half of the remaining shares that I had for a gain of 4.46. But remember, a lot of the partial profits I covered much lower here, $2 lower because of the partial profits. But because I was in trailing stop mode, the first close above a previous bar's high, I got out of the remaining shares 4.46%. But I still kept half, and the remaining shares that I have now are up 2.53%. But I think this is a good example of why it's important to take partial profits when you have them. I mean, did I wish I covered it all to low? Well, yeah, of course, but not going to be able to do that, right? So that's why it's important to take partial profits when you have them, but leave some for a bigger gain. And then am I glad at this point that I covered half based upon the closing stop rules? Absolutely, right? Because it's rallied since then. So I still have a little left, still up 2.53% on the ARC short. So let's go to IWM. Okay, IWM, I talked about this last weekend on the podcast. I said, okay, here we are. Let's see, so last weekend I said, look, we're getting close to the 200-day moving average. If we get a rejection of the 200-day moving average, I would be interested in buying. So you might ask, what's the confluence? Well, the confluence was one, possible rejection of the 200, and that happened. Two, we had a RSI divergence. If you remember last week, I said, look, here we are lower than this area, but yet the RSI is higher than this area. So this is called a bullish RSI divergence. So I had a bullish RSI divergence, right? This is going down, yet the slope of this RSI is going up. So that's one. And then the actual entry signal was the rejection of the 200-day moving average. So that was the trade. So on Monday, we had an intraday rejection of the 200-day. This is a deep dip buy signal. But overlaying on top of that, we had the bullish RSI divergence. So that's what made me take the trade. I got long 217.14. I position sized, as I mentioned. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above, and next day moved up, hit a profit target. Next day moved up, I hit 2 profit targets on this particular day. Then we had sideways and a little up on Friday. So you can see, nice trade based upon the deep dip buy of the rejection of the 200-day moving average, the black line, and like I said, the bigger picture confluence was that we were going down, but yet the RSI level was going up, and that is a bullish signal. So this particular trade here on IWM, the remaining shares up 3.5% in a week. That's a lot on an index. So hope this was helpful here. Simple deep dip buy and an RSI bullish divergence. Okay, let's go to QQQ. All right, I got long QQQ on the 14th at 505.10. If you remember, last week I was talking about connecting these bottoms here and looking for a third channel rejection. I'm connecting the swing low here. I'm rejecting the swing low here. Connecting those, going out into space. This is the channel line. This is where, if there's going to be some support, that's where I'm going to buy. I didn't buy on the day that this happened. I waited one more day. And why? Well, for one, I guess I should say on the day that I bought it, it confirmed what is called a bullish abandoned baby. And what's an abandoned baby? An abandoned baby, you need 3 bars. Here on the 10th, do you see how we gapped down? So there was bearish news, bearish sentiment, we gapped down. But the very next day after gapping down, we gap up. This is what causes this to be a bullish abandoned baby. And if you like to, bullish abandoned babies and island reversals, they're very similar. I have a really good video on YouTube. Just go to the lessons playlist, look for abandoned babies and island reversals. I use them. They're one of my favorite signals, both to the short side and the long side. But so we had a bullish abandoned baby, but then on the day that I bought, look at the channel line. So one, we have a bullish abandoned baby. Two, we come back down and we retest that line. We retest the channel line. And you know, I have a friend of mine, a student of mine, and I told him, I said, look, we rejected the channel line. Don't be surprised if tomorrow or in the future we come back and back test that line before we move up. It's exactly what happened. So I did get long here on the 14th because of the bullish abandoned baby and the retest of the trend line here. I got long 505.10. I placed my emergency stop 2 ATRs below, and my end of bar stop is simply a close below this channel line. I placed my 1.5 ATR trailing stop level above, and off we go. If we move up, I take partial profits. If we get to trailing stop level, I go into trailing stop mode. So got long here, 505.10. Next day, we had that big move up, hit 2 profit targets. Next day, we get to trailing stop level, but we did not close below previous bar's low, kept me in. And then, of course, on Friday, we had another big up day where I did take some more partial profits, obviously. So we are now, this particular trade is currently up 3.20%. Really, really good trade. But we are coming into some levels that concern me. And later on in the podcast, I'll get a little bit more specific of why, big picture, why I think we're coming into some major resistance right now on the Qs. But nonetheless, the long Q trade, because of the rejection of the channel line and the retest, up 3.2%. Okay, so those are the 4 open dailies that I have right now. Intel up 5.63% with the combination of the bullish order block and the deep dip buy signal, up 5.63%. ARC, the short position, covered half at 4.46 profit. The rest of the shares up 2.53, and this was the rejection of the bearish order block. IWM remaining shares up 3.5%. That was a combination of the intraday deep dip buy rejection of the 200-day moving average. But on top of that, we had the bullish RSI divergence, and then the Qs. I just mentioned the rejection of the channel line and the retest, up 3.2%. So those are the open daily positions. I also trade weekly positions as well. And so let's talk about those. Home Depot, really good trade. If you watched the podcast last week, you saw that I got long at 389.85. Why? Okay, this is a strategy that I have not used for a while, just because the market hasn't given it to us, but it did give it to us. This is called a return to value V1. So what is a return to value? Let's look at the green line here and the green line here. The bottom green line, the top green line. Anywhere in here is called the value zone. This is called a return to value V2. I'm sorry, V1. So the requirement on this is you need to be above, close above the value zone, right? Value zone's here and here. I don't like to buy above value. I want to at least buy in value and sell above value, or buy below value and sell in value. What I don't want to do is buy above value and then have to sell in value. Doesn't make sense, right? You don't want to buy, when you go buy something, you want to buy it on sale. Stocks are the only thing that people, for some reason, do not like to buy on sale. If you go buy some pants or anything else, you want to buy them on sale. But for stocks, people just want to pay the highest amount. And, in my teaching, that's what I teach all my students. Don't get suckered into buying above value. Buy into value and then sell above value. So, first requirement, we have to close above the value zone. Second requirement, we have to come into the value zone. Check, check. We did. We were obviously above, we closed in. Then I need at least 2 bars of sideways motion, meaning that it's going sideways, meaning that there's an equal amount of buyers and sellers at the same time. Because if it just goes into the value zone and keeps going down, there are not enough buyers there to give some kind of support, foundation, equilibrium, that there's an equal amount of buyers and sellers. Remember, if you go sideways, all that means is equal buyers, equal sellers. So here we have 2 bars of equal sideways. So when all 3 of those line up, 1, you're above the value zone. 2, you come into the value zone. So check, check. 3, you have sideways motion. Check, check, right here. Now I'm ready to enter the trade as long as I get a V1 or a V2 entry. Well, on this particular trade, it was a V1 entry. V1 consists of 2 bars. Bar 1, bar 2. Bar 2 has to go below bar 1's low and then close above bar 1's close. It did that. I got long 389.85. And if you want to learn more about V1s or V2s, just go to my YouTube channel and you will see that I have a video there that I go into a lot more detail. One of my favorite strategies, really, I just haven't had the opportunity to trade them, but boy, are they really, really good. And by the way, all these strategies that I use, the 7 different strategies, I do teach a private one-on-one course in the evening time via Skype. I teach my students, like I said, one-on-one, all the strategies, all the rules. They're going to know them when we're done with the course. They're going to know them like the back of their hand. And we do all sorts of simulation trades so that I know that my student really knows these and have these down. I've taught people from all over the world in so many countries, and I love to teach and I love to see my students succeed and learn new skills. And I taught from absolute beginners all the way up to the hedge fund level. So if you are interested in studying with me, I would love to teach you. Like I said, the course is one-on-one. It's the best way to learn anything, and it is 15 hours. It's a serious course. 5 sessions. Each session is 3 hours. That's where you get the 15. So if you're interested, my email is in the link of this YouTube video down below. Just send me an email. Say, Greg, interested in potentially taking your course. I'll write back, say, hey, great, let's do a Skype call. Skype call's free. It's not a sales call. I just want to get to know you better, know more about you, your trading, your challenges, your goals, and it's a good time for you to ask me any questions about the course. And so when we're done with that call, like I said, it's not a sales call. When we're done, we're done. And then after that call, if you're interested, if you decide, you know what, I like what Greg said and I want to learn, just email me back and away we'll go. And when you're done with this course, you will know a lot more about trading, and you will, all the experience I've had in the last 30 years, I will teach you. And this return to value V1, V2 trades, we'll spend lots of time and lots of hours on that. So anyway, above the value zone, into the value zone, sideways motion. I entered here 389.85. I placed my emergency stop 2 ATRs below. My end of bar stop on this strategy just closed below the washout bar. That's the bar 2 bar, 386. Placed my 1.5 ATR trailing stop level above. And I know exactly what I'm going to do, right? If it goes up, I'm going to take partial profits. If it closes below halfway the washout bar, I'm going to get out of the trade. If it goes crashing down and it gets my 2 ATR emergency stop. What happens? I get out. And how much have I lost? 1%. But luckily, this one went the right way. Score one for the good guys. And look, this week we did get to trailing stop levels. So I hit two profit targets on this move up, and I got to trailing stop level. Again, all that means is going forward in the future, if I have a close below previous bar's low, I will get out of half of the position. And currently, this particular trade, really nice in 1 week, up 4.17%. So that's return to value, V1 on the weekly, up 4.7. And then last but not least, excuse me, TLT. I talked about this last week. I said, big picture, look, we have, what's the green box called? Order block. Lowest bar close before market structure change. If we come back to the green area, that's where I want to buy, and that is where I bought. But I did mention last week, I want it to come into the order block, give me a V1 or a V2, or reject the top of the order block, which it did, and or see the big bar we have here on the third, the big up bar. When you have a big up bar, I know if you come back to halfway of that bar and reject it, that's also a good signal. And so that was my signal. Basically, two signals. This week we came into the order block. We rejected the halfway at 85.70, and we rejected the top of the order block. So that is why I took the trade on TLT, and that's why the market rallied. Right now, I'll just tell you, if TLT goes up, the market's going to go up. If TLT goes down, the market's going to go down, most likely, because the higher TLT goes, the lower interest rates are. The lower TLT goes, the higher interest rates are. So look what's happened to TLT over the last 4 months. We have just gone straight down. What does that mean? That means interest rates have gone straight up. Market doesn't like higher interest rates, and that's why we had the sell-off in the market. So the bonds here, TLT, that's why I got long, right? Got long 87.18. Position size correctly. 2 ATR stop way down there. End of bar stop on this particular one, I'm just going to go here with 85.70. If we close back under 85.70 next week, I'll just get out of the trade and wait for a different entry. And then my 1.5 ATR trailing stop was up there. So I'm basically a completely break even on the trade. But this is a good sign for the market. And also, we reject the negative third ATR channel as well. That's a deep dip buy signal, but I forgot to mention that. So a lot of signals here. Now, we may go back and retest, just like the market, just like the Qs when we broke that channel to the upside, we came back and retest. We may retest that. That is a possibility. So recap on the weeklies then. Home Depot with the return to value V1 up 4.7, and TLT, the one I just mentioned, break even. So those are the trades, everyone. So I hope that was helpful for you to kind of take a look and see the different strategies that I'm using and the different techniques. But yeah, really good. All of them positive. So very grateful for this week. So, okay. Let's talk a little bit about trader psychology before we get into looking at the possible trades for next week. This is my friend Thomas Payne. You can follow Thomas at Trader T Payne on X. And, the interesting thing about Thomas was a scientist. And so he got into trading, but he took, he's using the scientific method in his previous job, but he took the scientific method and applied it to trading. That's what always struck out to me about Thomas, was taking the scientific method that he learned in his normal scientist job and applied it to trading. So let's see what Thomas has to say. Large financial institutions move the market. They perform a ton of research. They buy what they think will grow. Their buying shows up on price charts. Once they start buying, they continue buying. Don't try to outsmart them. Follow their money trail. It doesn't lie. Okay, so why am I talking about this? So the reason I'm mentioning this is when I buy something, remember, I buy at the end of the day. the end of the daily bar, the end of the weekly bar, for this exact reason. During the day, you have all sorts of nonsense, tomfoolery going on during the day. But at the end of the day, the large financial institutions come in. They deal with the most money, they have very smart people, they have the best technology, they have the best information. And like Thomas says here, their buying shows up on charts. So that's why unless I hit my emergency stop, that is why I wait for the end of the day to make my technical buying and selling decisions. So how does this relate to psychology? For me, wait till the end of the day to make your trade for this reason. It's the most valid price of the day. And so if you're basing things off of technical levels, during the day it can go up and down, above it, below it, but at the end of the day, that's the most important signal, right? So comes back to psychology. Don't get in a rush to buy. Wait for the end of the day to make, if you're buying over a 200-day moving average, make sure that at the end of the day, it closes above. So one more time, large financial institutions move the market. They perform a ton of research. They buy what they think will grow. Their buying shows up on price charts. Once they start buying, they continue buying. Don't try to outsmart them. Follow their money trail. It doesn't lie. So thanks, Thomas. Appreciate that. And if you want, follow Thomas at Trader T Pain. It's a good follow for sure. Okay, so let's move on to the potential trades for next week, both on the daily and the weekly time frames. I'll share with you now what I'm looking for, what levels I'm looking for on these particular charts. So here we have on the daily 7 different potential upcoming trades for next week. Now, I mention this each week, but all 7 of these potentially could trigger on Monday. That does not mean I would take all 7 trades. I only take 1 trade per day per time frame. So even if I have 7 really good trades on Monday, how do I narrow it down to the 1? Well, I go through a process where I give the setups a quality score. For instance, if one Apple has 1 entry signal, but IBM has 2, well, which one do you think I'm going to take, right? I'm going to take the one that has the highest report card. And so I base that upon how many signals does it have, how many confluences of signals does it have, what is the risk to reward ratio. I also look at the higher time frame. That gives me more information because maybe on the daily, both of them look the same, but on the weekly, maybe one on the weekly is bouncing off the 200-week moving average, but the other one is not. Well, that would give me some good information and go, oh, the higher time frame is going to have me take the one that looks good on the daily, but is also doing something good on the weekly. And then I also look at the relative strength of that market compared to the rest of the market. If the market's down that day, but one of them is up, well, it has a higher relative strength than the rest. That would also give it a bonus point for that. So I look at confluences of signals, what the risk to rewards are, what the risk to reward ratio is on that on those trades, combining them all, looking at the higher time frame for some kind of technical support on the higher time frame, and then the relative strength. And this is what I teach my students in the one-on-one course that I teach. This is what I teach all of my students as well. It's really important to learn how to differentiate between this trade or that trade. And that's why I think the one-on-one course is really so valuable. Just the devil's in the details with this, and that's what I try to teach. So I hope you become my student one day. I'd love to teach you. I'll share everything that I've learned over 30 years in our lessons together. So let's start with Amazon here. Amazon, you see a red box here. That should be a clue that this is a potential short trade. And this is your order block here on the 16th of December. It's your highest up bar close. Before we change market structure to the downside, I want to look at some potential retest of that order block. I could have got short here because it did close in the order block and close below. I didn't take that trade. I think on that trade I took the ARC trade. And then again here on the 6th, we also got into that order block and rejected it. So you can see once we broke a market structure to the downside, didn't like the bottom of the order block, didn't like the bottom of the order block. Is it going to like it this time? I don't know. But what I'm really looking for, oops, I didn't draw this line perfect because I like to look for those confluences. And the confluence I see here is, here's the top of this swing high. Here's the top of this swing high. So this one, I'll just have to see what it looks like on the day that it happens, because I have two options. One, I could short the bottom of the order block. The bottom of the order block is 228.01 with a rejection to that. If it rejects there, I may take that trade. I don't know. I have other trades here that may look better, but that would be the first signal at least. Alternatively, if we go higher into the order block and we reject this trend line, see the high and the high, the two swing highs. If we reject that trend line, that might get me short as well. And then where would my stop be? Well, obviously I placed the 2 ATR stop above. And here I have a lot of options. If it rejects that trend line, I could place my end of bar stop very close at this swing high or at this swing high, or the easy way to do it's just the high of the order block. But it's hard for me to tell you exactly because I don't know what's going to happen. Basically, I'll know it when I see it. But for the purposes of this podcast, a rejection of the low of 228.01 would be the very basic. Going up higher, rejecting that downward sloping trend line, that would be better. If it doesn't do any of that and it continues higher and higher into the bearish order block and then has like a V1 to the downside, that could get me in the trade as well. So with these order blocks, it's hard for me to really kind of pinpoint exactly say how I'm going to take the trade, but I'm looking for a rejection of the bottom of the order block, a rejection possibly of the downward sloping trend line, some kind of V1 or V2, bearish V1 or V2 to the downside, or the most ideal would be we just go all the way up to the top, reject the top of the order block, and that would give me the very, very best risk to reward ratio. So I'm on the lookout for some kind of short for Amazon is what I'm saying. CCJ is Cameco. Okay, this was a legitimate trade on Friday. This is deep dip buy. We close under, we close over. Simple deep dip buy strategy. And by the way, if you're interested in the deep dip buy, and if you like online courses, I have a great online course on udemy.com where I teach you everything about the deep dip buy course. It's 9.5 hours of video. It's affordable. It's between $30 and $50 depending on the day. They set the price, not me. But I've sold so many of those courses around the world, 4.85 stars. Reviews. It's a great course. It's a great way to get started. And if you're interested, the link is in the description. The Udemy link is in the description. It's a great course, really great course. But the reason I didn't take this deep dip buy on Friday, and I could have, right? Because the previous day it closed below the 200, then we closed above. I don't like the risk to reward ratio. If it barely closed above the 200, I like it better, because if it barely closes above and then next day it closes below, I'm closer to my stop. Here, this moved up quite a bit. This moved up 4.28%. So my risk is all the way down here to the 200. So I didn't buy it for that reason. What I'm looking for now that we're above the 200 is a little bit of a pullback and a retest of the 200-day moving average that gives me a better risk to reward ratio. So that's what I'm looking for on CCJ. And the reason I didn't take the trade, although legitimate, is that the risk to reward ratio of the 200 is not good. So maybe this just continues up and up and away, and if it does, I just missed the trade. But if it does come back, retest and reject the 200-day moving average, would give me a better risk to reward ratio, then I would consider taking the trade there. Walt Disney. Wow. Everybody wanted this, now nobody wants it. But I like this trade a lot if we get there. What is the trade? Well, There are so many confluences here. So I'm looking, again, this deep dip buy. Deep dip buy, here's the 250-day moving average. Here's a 300-day moving, 250-day moving average. The black line's a 200-day moving average. The orange line is a 300-day moving average. These are all deep dip buy levels, and they're all kind of hanging around here in this same area, somewhere between 102.50 and 100.3. This to me is the buyable area. And if we come down and reject the 250, I may just take that. If we go lower or reject the 200, I might take that. If we reject the 300, I may take that. But the confluence here, you've heard me talk about this many times. I've had many trades on Disney with this. Look at the gray line, look at the black line. The gray line is the 50-day moving average. The black line is the 200-day moving average. When these cross over, that is called the golden cross. That is bullish long term. But when you have a deep dip buy at the 200-day moving average, the first move down to the 200-day moving average after the crossover, that is a very good risk to reward trade. And I've had many great trades when that happens. So I look for the 50 to cross over the 200, which it has, and then I look to buy the first rejection of the 200-day moving average after that happens. So this has happened, but we have not come down to the 200 yet. And it doesn't have to be the 200. It could be the 250, it could be the 200, it could be the 300. So that's why I made this green box here kind of from the 250 to the 300. So again, it's a patience waiting game. Disney might just take off from here and I'll never get the trade. But what I'm saying is I look at this and go, okay, ideally, if I could control the stock market and I wanted to buy Disney, where would it be? It would be in this green box area because there's major moving averages, 250, 200, 300, and we had the 50 cross over the 200. So I'm really going to keep my eye on Disney very closely because if it does get down here, I think very likely it will bounce, but not for sure. Okay, India, INDA. All right, well, we did create a bullish abandoned baby. Remember, here's the abandoned baby. We gap down, we gap up. When you gap down and then quickly gap up, more than likely in the future, you're going to be higher. Now, I could have taken this trade here. I didn't. But when you have an abandoned baby, the high of the baby, here's the baby, right? Hanging out here in space by itself. When an abandoned baby is created, if you move back down to the top of the baby, that's a very, very strong place to take the trade. So right here, 50.69. Next week, if we come down, bounce off that area, basically test this area and close back above it, then that's where I will be looking for a trade. I mean, buying right here, would it be the worst thing in the world? No. But to be very kind of specific and tactical, I want to see India, now that we have the bullish abandoned baby in place. Remember, that is kind of telling us more than not that we're going to be higher in the future. But I want to get a really good entry position. Well, that entry position is 50.69. So next week, if we come back down, test that level and close back above, very likely I'll buy it right there. McDonald's. All right, McDonald's, we are coming into a big confluence of moving averages. Again, deep dip buy. Here is the 200-day moving average. Here's the 250. Here's the 300. And we have an abandoned baby. On Wednesday, we gap down. Wednesday to Thursday, we gap down. Thursday to Friday, we gap up. So there's a bullish abandoned baby in place. Technically, yes, I could buy here on Friday. That would have been legitimate. But if we come, now that the abandoned baby's in place, if we come back down and bounce off the 250 or reject the 250 or the 300 or the 200, I think that's a really good area here. But keep in mind, if that happens, I may not be in the trade long because earnings are coming up here on the 30th, and I never hold through individual stock earnings. So, if it happens on Monday, I may take the trade. It might give me a week or so to be in the trade. But regardless, if I'm in the trade, positive or negative, I'm going to exit before earnings. But that's what I'm looking for on McDonald's next week is some kind of rejection, the 250, the 300, or the 200, because the abandoned baby's in place. Tesla, okay, well, you see a red box. That means I'm looking for a short. Here on the 18th was our highest up bar close before market structure change. What's the move when you have market structure change to the downside? Short when you get back into the bearish order block. So there's two areas that I'm looking for. There's the bottom of the order block, which is 457.51. If we reject that, that could potentially get me short. But interestingly enough, I have another level here at 452. Why this level? This is the red line. Look at the big down bar we have. When you have a big down bar, very often you'll rally back and fail at that big bar. See the big down bar? Getting back to half of that, it happens a lot of the time, but if it rejects that half bar next week, if we go up, we go above, and then we close down below that half bar at 50.52, I may get short there. Place my emergency stop 2 ATRs below. Then my end of bar stop on this one would be a close above this swing high here on the 26th of 465.33. Last but not least, VIX. You see green. That means I'm looking for a buy. Go all the way back. Oh, we have to go all the way back to the order block of 712.24. This was the lowest bar close before market structure change. So in the future, if you get back to the green box, very likely you'll have a bounce there. Look what happened here. It came back to the green box and bounced, obviously, hugely, bigly. So now are we at the green box? Well, the green box is about 41.82. No, we're not there. And you can see here on the 26th, we got very close to it again and it had another big rally. So if we come back down next week on the daily and we get to, and we reject 41.81, 41.88, that is the high of the order block there, I would potentially get long the VIX. And if I get long the VIX, what do you think the market's going to do? If I get long the VIX, the market is most likely going to go down. And this is a good time to talk about this anyway. So again, VIX, if it goes lower, what's the market going to do? It's going to go higher. But if it goes lower here, most likely it's going to bounce, and therefore what would the market do? The market would go down. So let me explain. So you see here why I want to buy VIX, but the market has to go up a little bit more for me to do that. So rejection of 41.84. If it rejects it, just like here, is it going to do this? I don't know, but it's legit because you're in the bullish order block. But let's switch over to the Qs. And I think we are getting to a level on the Qs here where we're going to run out of gas. So I talked about connecting the trend lines out into time. And that's exactly where we got, and that was the bottom. Well, let's do it to the upside. Here is a high, swing high on the 26th. Here's a swing high on the 6th of January. Draw that down. We are coming into some major resistance level on the Qs at about 524.74. So we may have another 3 points, 4 points to the upside before we get into that downward sloping trend line. In addition to that, look at the big down bar on the 18th of December. Again, halfway of that is going to there's going to be in some inherent resistance. So going forward next week, we have both. We have the trend line, we have halfway of the big down bar, serious amount of resistance here. So back to VIX, if the market goes up to here, the VIX will probably go down to the green area. There's a good chance it will bounce up. That's why I'm looking at going along VIX. And what will the market do? The market will come back down. So just big picture on the Qs, I am looking for this rally to stall out in this area. Will I short this? I don't know. I don't know if I will, but getting long the VIX is a proxy for that as well, right? So anyway, this is why I'm concerned about the cues here. The downward sloping trend line dovetailing pretty close to the big down bar on the 18th. This is a danger area here, and that is why it is a potential buy area for the VIX here. So those are the dailies. Let's quickly look at the weeklies as well. Weekly bars close on Friday, so I'll make my decision next Friday. Here is FXY. This is the Japanese yen. All the way back here on the 28th of June, lowest bar close before market structure change. That becomes our bullish order block. Go out into time here. I'm looking for some kind of rejection of the top of that order block to get long FXY. Nike. Oh man, Nike. No love for Nike. This is what I'm looking at Nike. This is a deep dip buy using the RSI. We're at 34.10 on the RSI. If we go under 30, over 30, that's a legitimate deep dip buy signal. We're not there yet. We're 34.10, so we have to go lower. But if that happens and we reject the 30 RSI, I will consider getting long. One, because it rejected the 30 RSI, and two, because we have a double bottom bullish divergence. Look at the lows over here, the deep red MACD bars. MACD is a momentum indicator. So if this is going down very strongly, you're going to have deep red MACD bars. Now, we are almost as low as where we were over here, but the red MACD bars, there are red MACD bars, but they are not as deep. What does that mean? It means we're running out of selling momentum from a MACD perspective. This is called a double bottom bullish divergence. I learned this from studying one-on-one with Dr. Alexander Elder, and he feels double bottoms bullish divergence is the strongest technical indicator in trading, and I would have to agree with him. It is very, very strong, and that is why I am looking at Nike. So the double bottom bullish MACD divergence is almost in place, and we are in the low 30 RSI. So with the double bottom bullish divergence, if it happens and I get an under 30 over 30, that would be my signal to get long. All right, makes sense. So basically, MACD divergence is almost in place, and under 30 over 30. So essentially next week, if we go under 30 during the week, but then close up back above 30, that would be the signal. And again, this is another thing that I teach in my one-on-one course are the double bottom bullish divergences. And I also teach double top bearish divergences as well. But with Nike here, looking to get long with the rejection of the 30 RSI. United Healthcare, UNH. Well, this one's pretty simple. 200-day moving average, you can see last time it respected it, these are weekly bars, we came down almost to the penny and bounced. We bounced, then there was some bad news this week. I am simply looking next week for Friday, if we come down, bounce at the 200-week moving average and have a good risk-to-reward ratio, or go below it during the week and then close back above it, that would be a good deep dip buy signal on UNH with the 200 weekly moving average as your line, as my line in the sand. WBA, huge move up this week, 6.67%. Last week, I can't remember, kind of curious. Let's see what it was last week. Last week, 23% up. So we're up almost 30% in the last 2 weeks on WBA. But I am not looking to buy here. I don't buy above value, but I am looking for a short. What's the short? Okay, here is the red box. What is that? That is a bearish order block. Highest up bar close before market structure change. Therefore, if I get back up into this area, somewhere between 14.19 and 15.26, this is the shortable area for me. But it's going to take a while to get there. I don't know. It's been really strong. Maybe it goes up. I don't know. But so if we reject 14.23 up to 15.56, I will consider getting short WBA. But the first one would be at 14.33. If we touch it, close back below it, that would be my short. My stop would be a high above this swing high here. Let's see which one's higher. Here above 1340. But I need a rejection. I need a rejection of the bottom or a rejection of the top. So the bottom's 1423, the top's 1533. So rejection of the top and the bottom, or some kind of V1 or V2, bearish V1 or V2 in the order block. So I don't know if it's going to get there, but if it does, I'm kind of excited about that potential short. XLU is the utility sector, red box, looking for a short. We have a high, followed by higher high, break to the market structure to the downside. If you break to the downside, what do I want to do? I want to short rallies. So the high and the low of the order block here of the 29th is 8103 up to 8357. So in other words, the first signal would be a rejection of 8103 or rejection of the top at 8364, or again, some kind of V1 or V2 to the downside. And again, if you want to learn more about V1s, V2s, just go to my lessons playlist on YouTube and you'll see. So looking for a short there. And then last but not least is XLV, which is healthcare, which has really gotten pummeled over the last 3 months or 4 months. Pretty simple here. Deep dip buy at the 200-day moving average. Look all the way back here in October. We got to the 200-day moving average, 200-week moving average, and the negative third ATR channel. Was that a good trade? Yes, it was. Will it be here? I don't know, but we have the same thing going on. Look, the 200-week moving average, the black line, is dovetailing exactly with the negative third ATR channel, just like it did here. Yeah, if it gets there, rejects that next week. I don't know if it will, but if it does, I will be very interested in getting long XLV. So those are the potential daily and weekly trades for next week. If you have any questions on any of them, please feel free to put them in the comments section. I'll do my very best to get back to you. Again, if you're interested in one-on-one lessons with me, I teach 15-hour one-on-one course. Love to have you as a student. You're going to learn a ton. You're going to have a skill that you can use the rest of your life. I promise you're going to love it. Also, the online Udemy course for deep dip buy, not as good as one-on-one, obviously, because you don't have me, but you do have me in video form, and that's very affordable as well. So the link's there. So I hope you have a good rest of your weekend. I hope you have a good trading week next week. Please try to go out and do something nice for somebody today. If we all did one nice thing for another human being, the world would be really a better place. And if you could also go and try to do one nice thing for an animal today, I would really appreciate that. They appreciate acts of kindness just like we do. So one nice thing for a human, one nice thing for an animal, and what could it hurt, right? What could it hurt? But I appreciate you being here. If you found any value today, again, I'd appreciate if you could hit the thumbs up button. And I just hope you have a good rest of your weekend. And God willing, I will be here. I'll see you next week. But be careful next week. Like I said, be careful. On the Qs, on the SPY, we are getting to some serious overhead resistance levels. So don't get caught up into the, the rah of, oh, hey, we're going back up to all-time highs. We might, but we are coming into some serious resistance levels from trend lines and the halfway of that big down bar. So please keep that in mind. We've had a big rally. Rallies don't go on forever. And so keep that in mind. Always be careful. And again, if you have any questions, feel free to put them in the comments section. All right, everybody. Thanks again for your time. See you later. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.